financial institutional risk. We know what happened now because they admitted it. First person who admitted it was Alan Greenspan. He said, quote unquote, I found a flaw in the model that I perceive is the critical functioning structure that defines how the world works. So basically we had a Federal Reserve president that was relying on theory and philosophy that was incorrect. Robert Shiller, the housing bubble was a major cause, if not the cause, of the subprime crisis and the broader economic crisis we now face. Housing price bubble, there was no underwriting, there was corruption across the whole system. It created asset price bubbles, and then the bubble burst, with major implications on financial institutions, and the Fed having to come in and basically bail out the system. And then Chief of Staff Rahm Emanuel, I think, shows behind the curtain how policy is actually made. Never let a serious crisis go to waste. What I mean by that is it's an opportunity to do things you couldn't do before. In crises, you can push through policies that you otherwise would not be able to push through in a democratic, pluralistic debate process. So a lot of policies to cure the financial crisis were pushed through the system and enacted by both parties that otherwise would never have been enacted if it had been debated in a more public sphere with more scrutiny. Here's the credit facilities that were created, and you can see just the list. And down at the bottom here, you can see how much they actually spent across all these facilities to bail out the system, which was $3 trillion, but there was an $11 trillion commitment. So the policies that were put in place had basically an $11 trillion line of credit to bail out the system. We only spent 3, but we had 11 trillion in the wings to be able to use, and that's how bad the situation was. We spent 3, we had 11. Right now, Europe is going through theirs right now. They've already printed $3 trillion. They're implementing quantitative easing 5 years after the fact, and they're starting to go into the bond market, buy bonds, drive up bond prices, and drive down interest rates to try to stimulate the economy under a restrictive currency regime under the euro. So we'll see how successful they are. But you can go through and just look at all the credit facilities that were made available to basically bail out the system and cure the market failure. And then I'll end it on this one. To really understand how those credit facilities really worked and how the system was saved was looking at the bank's balance sheets. Okay? So when you look at the bank's balance sheets, you have reserves, you have cash, you have bonds, right? Muni bonds, treasury bonds, other types of bonds. You have loans. Loans are assets on your balance sheet. Mortgage loans, consumer, other types of loans, and other assets. So this is the asset side. We're going to focus on the securities that they held and the loans that they held on their balance sheet. To fund these assets, we use deposits, savings deposits, CDs, bank equity in the bank. Capital, bank capital, highly liquid, tier 1 capital, owner's equity in the bank. Assets have to equal liabilities. What happens when the system is in distress? The bonds that you are holding on the asset side of your balance sheet are being downgraded because the realization is by institutional retail investors is those bonds have been misunderwritten, are actually higher risk, more risk, at a higher risk than you had anticipated when you bought it. And as the investors started to sell the bonds, the bond prices collapsed and the yields went through the roof. And the other way around, yields went through the roof and the bond prices collapsed. So imagine you're sitting on a bond or bond portfolios where the value of those bonds have been impaired and driven down, in some cases, worthless. So now your asset liability structures are mismatched. Your assets have gone down, and now your liabilities, which you can't restructure instantaneously, have now gone through the roof. And you might get debt covenants too. You might hit debt covenants on your debt because your assets went down, your debt ratios went up, they hit the covenants level. Now you have to sell more assets to buy off the debt to bring down the debt levels. You might have to sell off some of the loans. Well, some of the loans that you had on your balance sheet were, again, misunderwritten in that the borrowers are defaulting on their business loans, on their real estate loans, and now the value of the loans on your balance sheets have now gone down, and now you might have to actually foreclose and take those properties back at a severely lower price. So the assets were collapsing. The liabilities, particularly the bond structures, were in place. So theoretically, assets have to equal liabilities. What happens? It wiped out the capital in the bank. The bank was insolvent. This was basically almost every single bank, particularly money center bank, large money center banks in the United States were basically insolvent. So to prevent a run on the banks, the Federal Reserve and the Treasury stepped in and created those Treasury and those fiscal policies and enacted them and pushed them through very quickly. First thing they did was on the TALF and the TARP, they were able to come in, buy the impaired securities off their balance sheet, recapitalize them, give them some liquidity, and have them hold treasuries. And then drive down interest rates and prop up the bond prices on the asset side. So the first thing they did was they bought all the junk bonds off their balance sheet, gave them treasuries, gave them liquidity, and shored up the asset side of the balance sheet. Second thing they did is they changed the FASB rules, the accounting rules, so that they didn't have to mark the securities to market and they didn't have to mark the loans to market. They could hold them on the balance sheet at book. So it was basically an accounting gimmick to stabilize the assets on the balance sheet so that they wouldn't continue to go down. And then they slowly had the loans reviewed by the regulators, would come in, would examine the banks, and then slowly they would have to write off the loans as impaired. Or what they would do is, because the interest rates were so low and they were still making some money on loans, is they were building loan loss reserves. And then once the loan loss reserves reached a certain point, they could start to write down the loans or sell off the loans to get them off the balance sheet. So this was really the asset side that they were trying to shore up. On the liability side, some of the major banks issued convertible preferred stock, convertible preferreds. Preferreds are considered equity, not debt. So by issuing preferreds, it pushed up the equity component of the liability side and pushed down the debt ratios. And the preferreds could be converted into straight equity at some point in time in the future. So by injecting convertible preferreds, and some of the banks had to issue straight equity, it propped up and stabilized the capital component of the bank. And actually the ones that did take money from the Federal Reserve for convertible preferreds were partially nationalized, although Citigroup would never tell you that. And a lot of the banks, you name it, B of A, JP, Goldman, Citi, a lot of them took these convertible preferreds, issued these convertible preferreds to the federal government. So that was the asset liability management that allowed the banks to stabilize the balance sheets and prevent probably one of the biggest run on the banks that could have emerged since the Great Depression. And you really saw it, and I'll end it after this, you really saw it when Iceland went bankrupt, in Spain, in Portugal, in Italy, particularly in Greece and Iceland. You saw a run on the banks. When this occurred, the government really wasn't there. You saw lines of people outside their banks pulling out cash to try to get the money out before the bank went bankrupt or insolvent. So I'll end it there.